What we are not seeing is a deterioration between what we were expecting in the credit cycle in any of the portfolios. So I think that credit remains solid from credit cards in the US all the way to big corporates. But we will see how it plays and continues once the economy. I don't think that the economy will go into recession. It's likely to slow down. And the credit cycle will continue to normalize. But I don't think that in the credit cycle we see a deterioration beyond what we were expecting.
If the economy slows down, where do you stand on the interest rate debate in America at the moment? Do you think the Fed is going to cut again in December or hold off?
I think that it may be some inflation is being quite resilient. Growth is slowing down, but it's still, this quarter I think that we should discount the numbers wherever they can because of the shutdown, that it will recover. Whatever it is, it will recover in the next quarter, in the first quarter of next year. So we do see some deceleration. We do see some reduction in consumption, but it's still for healthy levels. So I think that the economy may grow less next year, but most likely it will avoid recession. Tariffs, they haven't had the full impact, but some will have a further impact next year, but also some will be compensated by the fiscal expansion. So I am relatively positive on what we are seeing. Having said that, markets are pricing a very, very benign scenario and quite a bit more. So that I don't know. There may be issues or not, but the S&P at 6,700 or so, 23 times is quite healthy, to say the least.
You're not giving us a new S&P target.
Well, whoever was giving target missed it all, so no. But I think that from here, you would have saw that the upside is relatively limited.
Obviously, no on-stage interview these days can't include AI. So here's the AI question. Where do you stand on the continuum of hype, bubble, and it's going to solve everything?
Well, the technology is real, and we are, even though we've been dealing with traditional AI for the last 10 years, we are now working in large language models, and we deploy that to almost every employee that we have. We are using different forms of this to improve productivity across operations, technology, detecting fraud, surveillance, credit decisioning, improving client experience. It's all over the place. But it's still at a very early stage. So large language models that are still not having the impact that they should have, and we're still very, very early in the agentic journey. Clearly, this will have an impact in the labor market. Some jobs will be created and some jobs will be eliminated. But I think that one thing that ones want to keep an eye on is how much capacity is being created, and how all these companies, how much revenues they are going to get to compensate, to pay for that capacity. Is likely, I don't know the probabilities, but it's possible there is probably a correction there. And that correction will also create a correction in the rest of the segments in the S&P and in the industry, because you are probably, in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing.